Good morning and welcome to the B.F. Anderson Technical Report for April 28th. I wanted to make one note. I will be on the Jim Inkster Show Monday morning next week at 9 o'clock, WRKF 89.3. We'll be discussing the market and the current economy. Hopefully we'll discuss the Trump tax proposal because I think it's exceptionally good and excited about it. We do not want to underestimate the benefit of tax cuts, which is fiscal policy. As I said in past videos, we're moving from monetary policy to fiscal policy, which is more of a growth-oriented policy. In the past, and I mean, I'll state this, in 1921 we had tax cuts, in the 1960s we had tax cuts, and then we had tax cuts in the 1980s. In each of the circumstances, revenues to the Treasury jumped dramatically, and the GDP growth rate jumped dramatically up to the 5-6% area. But anyway, I wanted to bring us up to date a little bit here on the 7.5% rule, which I have talked about in the past. Now remember, 7.5% is the spread between the 35-week moving average and the index itself, which we hit 2365.38 on the S&P on March the 8th. If you remember, the importance of this is it's very rare. This has only happened 10 times since 1980. In each of the situations, the pullbacks have been very minor. So the maximum pullback we've had since the signal was given has been about 1.3%. The average over since 1980 for the 10 times has been 2.5%, and in a lot of the cases, there was really no pullback whatsoever. So any pullback should be used as a buying opportunity, and you can see what has happened here. Now, I want to have a quote here. Bull markets come out of the night. You cannot predict this. These things are going to happen before you realize they're happening. So let's take a look at a bear market. This is a bear market. This is what I've done here is I've got the 200-day moving average. This line is the 200-day moving average. It's kind of complicated, but let me simplify it. I'm comparing the Standard & Poor's 500, which is stocks, to the TLT, which is long-term bonds. So I'm comparing stocks to bonds. So when this line is going down, it means that stocks are doing worse than bonds. So if you go back to the 2008 bear market, you can see here that it was a very decisive downturn in that combination where bonds started outperforming stocks in a dramatic way, and after that breakdown, really bad things happened, which was the worst recession since the Great Depression. Which, by the way, I want to mention, there was a movie called The Big Short, and the whole point of the movie was, to me, was that no economists or financial professionals predicted this. It was just one guy. That's what the movie's all about. So this is why trend following is so important, because nobody can predict this. I'm just telling you. So we saw a major breakdown. So let's look at where we are now. So you kind of have to ask the question, if you see a graph like this, would you be bullish or bearish? Well, my goodness, you have to be bullish. Again, what I've got here is the 200-day moving average comparing stocks to bonds, and when the line is going up, it means stocks are outperforming bonds. This is a very bullish pattern here. And so we saw this turn right after the election. I mean, it looks like to me around the last couple of weeks in November, around the time of the election, we saw a major upturn in this comparison. Now, just to kind of show you, and I did want to mention my email address is andy.anderson@bfanderson.com. So, feel free to email me if you have any stocks that you would like me to prepare these types of graphs on. But this is Exxon. As you can see, just a definite downturn here in the moving average, the 200-day moving average. Remember, Ned Johnson of Fidelity was asked if you had one indicator, what would it be? And he said it would be the 200-day moving average. Well, when you see the 200-day moving average turning down like this, it just tells you that's a group that you would want to stay away from. Now, here's a stock that we're interested in, is a company called Shopify. Well, look at their 200-day moving average. This is very, very constructive. Now, what I'm seeing here is a pattern, not just in Shopify, but I'm seeing a pattern in anything to do with cloud-based computing. These are what we call software platforms where, the best example is Netflix. When you think about all the movies that you can see on Netflix, it's tens of thousands of movies. Well, your little iPhone or your little iPad can't store tens of thousands of movies, but Netflix has a server farm, which is in the clouds, that transmits a wireless signal to your mobile device so that you can watch movies. This is a real growing trend. This could be really big, as big as the internet itself, or if not bigger. Now, here's another example of just another 200-day moving average. Now, the reason I picked Verizon here is it's a dividend-paying situation. Now, without getting into too much detail, stocks are for growth, bonds are for income, is the rule. And if you think about stocks, you're making an equity investment. You're buying, what you want to see is your equity in that company go up. Now, when a dividend is paid, it reduces the equity. It's like a reverse mortgage. In other words, if you have a traditional mortgage on a house, every time you make a monthly payment, you increase your equity in the house. Whereas a reverse mortgage is where the money's going out to you, your equity in the house is going down. So a dividend is the same thing. When a corporation earns money, the shareholders' equity goes up because of the retained earnings. But then when the earnings are paid out in the form of a dividend, the stockholders' equity goes down by the amount of the dividend. So you really kind of, I call this the toothpaste stocks because people run to these types of stocks in difficult economic times. And you think about, you got to buy toothpaste, right? So what I'm saying is there are a group of stocks out there that are very defensive in nature that are starting to show signs of deterioration, and I'll show you two of them. If you have any questions, give me a call. Have a good weekend. Thank you.